All right, we have a few days under our belt in accounting class, and we studied the financial statements, the income statement, the statement of owner's equity, and the balance sheet. And so now that we kind of understand these statements and what goes into them, now we're going to analyze and interpret them. And one way to do that is to use ratios. So I'm going to walk you through a few basic ratios right now. And when you think of a ratio, a good analogy is, I always give this example, is you think of a point guard in the NBA. What makes a good point guard? A point guard basically on the basketball court is in charge of handling the ball, not giving it to the other team, which is called a turnover, and to pass it to his or her teammates in a position where they could score. And we call those assists. So a good metric when we measure a point guard is what is called assist to turnover ratio. So you take the number of assists that they have during a game and you divide by how many times they give it away to the other team, which are called turnovers, and you kind of get that metric. Now obviously there's rebounds, points, and financial ratios are exactly the same thing. We don't just look at one, we're going to look at all of them kind of together. One tells us a barometer for that particular area we're looking at, but we don't want to just take one and come to a conclusion, if that makes sense. Alright, so the first ratio we have is the quick ratio. The quick ratio is a liquidity ratio. And as we talked about in class, our three most liquid assets are cash, accounts receivable, and short-term investments. And basically we want to look at, do we have the ability, does the firm have the ability to pay off their current liabilities, which are due within a year, by using their most current assets, which is cash, short-term investments, and receivables. So we take the three of those, we add them up, we divide by the current liabilities. So now that we kind of know a little bit about the formula, there's the cash and receivable. Note there's no short-term investments in this company. And then we divide it by our current liabilities. In this case, accounts payable, money owed to customers, wages payable, money owed to our employees, and then obviously taxes. Taxes are due within a year. So those are your three current liabilities. So when we calculate that, we get a ratio of 1.85. So now we have to interpret the ratio. What this means is for every dollar we have in short-term liabilities, we have $1.85 in our most liquid assets to cover those liabilities. So the 185, we want to look at this 1.85 as a comparison to previous quarters for the company. We could kind of analyze it. Is this number getting bigger, smaller versus ourselves? And then we also want to compare it to the industry average. Alright, so that's a very, very basic liquidity ratio. The next one is the current ratio. So this takes into account all your current assets divided by your current liabilities. So obviously you could liquidate your assets, those longer terms like inventory and things like that. So the current ratio is just another metric. Well, if things get really bad, can they really meet their current liabilities? So much like before, we just plug and chug now. And there we go, we get a metric of 3.96 is our ratio there. So once again, we're going to compare it against prior quarters. Now since business is cyclical, we're not going to take that ratio from quarter 2 and compare it to quarter 1. We're going to take the quarter 2 ratio of this year and compare it to the quarter 2 ratio of the prior year. And we want to kind of keep an eye on that. The next one we have is the gross margin ratio. And this is a profitability measure. How profitable is every sale that we're making? And remember, the gross margin, we talked about this in class. I'm going to move my cursor here. Your gross margin is your sales minus your cost of goods sold. So for every dollar you sold, what was the input for that inventory you're selling? So that's the cost of goods sold. And then you get your gross margin. So the gross margin ratio is taking that gross margin and dividing it by sales. So when we do that, there's the gross margin, there's the sales, and we get 38%. So that's basically the way we read that. For every dollar we have in sales, we walk away with 38 cents after we take out cost of goods sold. The lowest gross margin ratios you'll find out there is generally the grocery store business. They're running really, really low ratios, under 3%, 2%, very, very slim margins there. But you got to remember, they sell tons and tons of groceries, tons of items every day. So the volume makes up for the smaller ratio. All right, return on sales ratio. When I see the word return, I think of the word net income. So I'm looking at my net income over sales. So there it is, net income over sales. And so we go to the income statement for this one. And you kind of really can't see it there. I kind of have it cut off there at the bottom. But it comes out to 27,500. It's below the screen there, but 27,500. It's 39,285 minus that. And you can't see it. It's kind of cut off there. There's the 27,500 divided by sales, gives you a return on sales ratio of 6.88. So that means for every dollar in sales, we make 6.8 cents in income. So we keep an eye on this return on sales. Is this number getting bigger, smaller, and if it's really kind of changing quickly, we want to kind of get a grasp. Management wants to know, why is this number falling quickly? Is something going on? Is income going down? Are expenses going up? Commodity prices rising? Are we lowering our sales price too much to compete with competitors? And so then we have to make decisions. All these metrics we look at globally for a business. Internally, the managers are going to break down these ratios by product line. If you look at a company like Procter & Gamble, they have hundreds and hundreds of products that they sell, and they do this for all their products. Okay, accounts receivable, we learned, is when our customers owe us money. So we want to see what that turnover number looks like. So it's the sales amount divided by the receivable. And we get a turnover rate of 9.9379 times. And we want to look at basically, we want to look at how many days it takes us to collect on our receivable. So we take 365 days in a year, we divide it by the turnover number. So it takes us on average 36.73 days to collect from our customers. And obviously, like I mentioned in class, we want to lower that number. We want to collect from our customers quickly. Therefore, we could take that capital and reinvest it back into business quickly. All right, the last one is inventory. How long are we holding on to inventory? Remember, inventory is very costly. If we hold on to it for a long time, we got to insure it. We might have to pay interest on it. It takes up physical space. Remember, we're paying, for the real estate our business is on. So we want to keep that inventory moving. So we look at the inventory turnover numbers, the cost of sales divided by the average inventory. And in the last ratio, we take an average because it smooths out the inventory. This is inventory on day one, 64,000. At the end of the year, we have 72,000. We don't want to pick either number, and so what we do to kind of get an average inventory amount, we add the two up and we divide by 2. And so we get an inventory turnover number of 3.64, and once again, there's 365 days divided by 3.6471, and we get 100 days. It takes us 100 days. By the time the inventory comes in our front door, by the time we sell it, we hold on to inventory for an average of 100 days. All right, so that is basically it. This is kind of just extra stuff. We'll kind of go back here. Basically, that's it. Those are some of the basic ratios to kind of get you started and just practicing with those. All right, we'll kind of talk more about these in class.